Welcome back to Investing Talk Podcast.
Today we are looking at a company that, if you asked me 6 months ago, I would have told you was on life support. We are looking at AtlasClear Holdings. And honestly, looking at the data today, this feels like we are witnessing a massive turnaround story unfolding in real time within the fintech and clearing space.
Okay, let's unpack this right out of the gate, because when I see a name like AtlasClear ticker ATCH, my brain immediately goes to legacy debt and uh, spin-back disaster. This was a company that, let's be honest, was absolutely laden with liabilities coming out of its de-SPAC process. It felt heavy, it felt risky, it felt like one of those companies that just slowly bleeds out until it hits zero. So why are we looking at it now? What changed?
What changed is the balance sheet. And I don't mean they just moved some numbers around or got a temporary loan. This is a fundamental transformation. They have successfully extinguished over $43 million in legacy liabilities. That is over 80% of their total debt load gone.
80%? How is that even possible without bankruptcy?
It was a brutal restructuring process, but they pulled it off. They've gone from a position of negative equity, which, as you know, is usually a red flag the size of a football field,
A huge one.
to positive stockholders' equity of $21.7 million. So when you ask, so what? The answer is that this isn't just a survival story anymore. They aren't treading water. This is a completely cleaned up vehicle ready to operate.
That is a massive swing. Going from negative to over 20 million in positive equity is, well, it's rare. It's like watching a house that was on fire suddenly get renovated overnight. But before we get too excited about the comeback, as usual, before we start, subscribe, like, and comment to this video to support the show. We dig through the numbers so you don't have to, so hit that button.
Absolutely. And once you've subscribed, let's look at what that clean balance sheet is actually supporting. Because a clean balance sheet is nice, but you need a business attached to it. An empty house is still just an empty house.
Right. You can be debt-free and still have zero revenue. So are they selling anything? Or is this just a shell?
They certainly are selling. We just got the numbers for Q2 of fiscal year 2026. Revenue came in at $5.1 million.
5.1. Okay, give me the context. For a fintech infrastructure play, is that good, bad, or indifferent?
It's an 84% increase year over year. Previously, they were sitting at roughly 2.7 million, so they haven't just inched forward, they've nearly doubled the top line.
That is significant growth. But I have to ask, where is it coming from? Is this a one-time windfall? Did they sell a patent? Or is there an actual engine running here?
It's the engine. The growth is being primarily driven by their subsidiary, Wilson-Davis. They are seeing real traction in correspondent clearing, stock loan, and underwriting.
Correspondent clearing. We see that term thrown around a lot in fintech press releases, but let's clarify for everyone listening, what exactly is the business model there?
Sure. Think of it as the plumbing of the stock market. If you launch a new trading app tomorrow, or if you're a small regional broker, you don't usually have the infrastructure to clear and settle trades yourself. It's too expensive, the capital requirements are massive, and the regulations are, well, a nightmare.
So you outsource it.
Exactly. You hire a firm like Wilson-Davis to do the heavy lifting in the background. Wilson-Davis clears the trade, handles the money, ensures compliance, and takes a fee. It's a volume game. And crucially, it is very sticky.
Sticky.
Imagine trying to change the plumbing in your house while the water is still running. That's what it's like for a broker to switch clearing firms. Once they integrate Wilson-Davis, they rarely lose. That creates a recurring, reliable revenue stream.
Okay, so they are the infrastructure layer. I like that model because it's B2B and high retention. But I have to play the skeptic here. We see companies grow revenue all the time by spending a fortune to get it. I can sell dollar bills for 50 cents and show you amazing revenue growth. Are they actually making money, or are they just burning cash to grow that top line?
That's the critical question, and this is where the turnaround becomes tangible. They swung to profitability. Earnings per share, or EPS, hit 5 cents.
5 cents positive.
5 cents positive. Compare that to the year prior, where they were losing $1.11 per share.
Wow.
That is a massive improvement. Net income came in at $6.8 million.
Okay, 6.8 million net income. That sounds great on a headline. But I'm looking at the notes here in the 10Q, and I have to add a note of caution. That net income number, it wasn't purely from selling clearing services, was it?
You're right to spot that, and this is why we look closer. Yes, the net income was driven by operating growth, but there were also significant non-cash adjustments that boosted that final number. Things like changes in the fair value of warrant liabilities.
Exactly. Non-cash adjustments are accounting magic. It doesn't mean it's fake, it's GAAP accounting, but it
Yeah.
means we can't just assume they have $6 million of extra cash in the bank from operations alone. It's a mix of better operations and, balance sheet restructuring.
That's a fair distinction. We shouldn't annualize that number blindly. However, even if you strip out the adjustments, the trajectory is undeniably upward. And speaking of cash in the bank, we don't have to guess about their liquidity. They are sitting on $46.2 million in cash and restricted cash.
46 million. For a company with a market cap of this size, that is a fortress.
It is. Total assets are now nearly $78 million. And they didn't stop there. They recently secured a $20 million financing package.
Right, I saw that. 10 million in convertible notes and 10 million in equity units.
Exactly. So they have cash on hand, they have access to capital, and they have a growing revenue stream. This liquidity boost is huge because it removes the going concern risk. They aren't going to run out of money next month.
Which brings us to the why. Why do they need this money? What is the strategy? Because being a clearing firm is a solid business, sure, but is it a high-growth business?
That's where the technology-enabled platform comes in. They aren't trying to just be a traditional broker. They are integrating trading, clearing, and banking into one stack.
The vertically integrated model. Everyone wants to be the super app of the back end.
Precisely. And they have a specific tool called Lockbox.
Lockbox. Sounds like a storage unit. What is it?
It's for stock loans. When you want to short a stock, you have to borrow it first. You have to locate the shares.
Right, and usually that involves a lot of phone calls or messy electronic messages between brokers.
Exactly. Lockbox is a tech solution that makes locating that inventory easier and more efficient. It's a piece of proprietary tech that keeps their clients inside their ecosystem. They are building high switching costs. If you are a fintech startup and AtlasClear is handling your clearing, your stock loans via Lockbox, and potentially your banking, leaving them becomes incredibly difficult.
Stickiness, that's the mode. Okay, so fundamentally, the house is in order. The debt is gone, revenue is up 84%, and they have cash. That's the business reality. But let's pivot to the charts, because the market doesn't always reflect reality immediately. What are the technicals telling us?
It's interesting. When you look at the price action following these earnings, there is a clear stock uptick. The market reacted to the Q2 results.
Well, sure, you beat revenue by that much, the stock should move. But is it a sustained move? Or is it a dead cat bounce?
I think we are seeing psychological support building. Think about it. 6 months ago, if you looked at this chart, you were terrified of bankruptcy. You were looking at a chart that could go to zero. Now that floor is solid. The fear of bankruptcy is gone. That creates a psychological floor for the price. Investors are no longer pricing in an existential crisis.
That's a really good point. When you take zero off the table, the risk-reward ratio changes completely. But I'm looking at the momentum indicators, and I'm seeing something that suggests we aren't quite in moonshot territory yet.
No, not yet. The sentiment scores suggest consolidation before upside. The market is still digesting. You have the earnings volatility. You have M&A announcements. It's a lot of information. The market is in a wait-and-see mode. They want to see if that strong revenue growth can actually drive higher highs or if the price will just stabilize here.
And what stands out to me is the volume, or rather, the lack of it. There are no explicit high-volume mentions in the major data feeds yet. This isn't a meme stock. It's not trending on social media.
Which is fascinating, right? It means this is flying completely under the radar. It hasn't been discovered by the retail mob yet.
Which brings us neatly to the wider market perception. Let's shift gears to sentiment, because usually when a company doubles revenue, people are screaming about it. What is the quantitative score here?
It's a zero.
A zero.
A perfect neutral score of zero.
That seems harsh. They just fixed their balance sheet and grew revenue 84%. Why is the sentiment neutral? Is nobody watching?
Because the news is purely factual. The algorithms picking up these stories are seeing earnings reports and acquisition details. It isn't hype. It's execution news. There's no emotional language driving the score up or down. It's just company A did X.
That's actually a very crucial distinction for you listening. A neutral sentiment score doesn't mean people hate the stock. It means there is no hype bubble.
Exactly. I interpret this neutral score as a massive opportunity. It means the hype train hasn't left the station. If the sentiment was already at a 9 or a 10, I'd be worried we were buying the top. But at 0, it implies the market is efficiently processing the facts, but hasn't got excited yet.
Facts over feelings. I like that. But let's check the smart money. Usually when a turnaround is this clear, you see the insiders swooping in. Do we see any Form 4 clusters? Are the directors buying with both hands?
Surprisingly, no. There are no specific Form 4 cluster buys or 13F accumulation detailed in the data yet.
Yeah, that makes me pause. If the water is so warm, why isn't the management jumping in? If they believe the stock is undervalued, they should be buying.
It is a fair question, and usually I would agree with you. However, I would argue that the $20 million financing is the signal. You don't get $10 million in equity units and convertible notes from partners if there isn't strong internal and partner confidence. That financing is a vote of confidence in the strategy, even if it's not an open market buy from a CEO. Institutional money is smarter than retail money, and institutional money just put $20 million on the table.
That's a valid counterpoint. Institutional financing is a different beast than retail buying. Now, we touched on it briefly, but we need to address the rumor check, or rather a big catalyst on the horizon, the commercial Bancorp acquisition.
This is the game changer. This is the piece of the puzzle that turns them from a clearing firm into a fintech powerhouse. They are in a pending deal to acquire a commercial Bancorp.
Okay, stop. Why does a clearing firm want a bank? Is it just for the prestige? Because owning a bank comes with a headache called the Federal Reserve. Why invite that scrutiny?
It isn't for fun, and it isn't for prestige. It's for the cost of capital. This is the arbitrage.
Explain that arbitrage to me like I'm 5.
Okay. Right now, if AtlasClear wants to lend money to a client, say, for a stock loan, they have to borrow that money from somewhere else. Maybe they pay 7 or 8% interest on it.
Okay, so their margins are squeezed.
Exactly. But if they own a bank, they have access to deposits. Your checking account, my savings account. What does the bank pay you for that? Maybe 0.5%?
If I'm lucky.
Right. So if they own the bank, they get access to capital at 1% or less. Then they can turn around and lend that money out in their clearing business at 8%. That spread, that gap between 1% and 8% is pure profit.
Okay, I see it now. Management is calling the deal accretive. That's the magic word. It means it adds to earnings per share immediately because their raw material money becomes cheaper.
Exactly. It allows them to control the entire life cycle of the trade and the money behind it. Vertical integration isn't just a buzzword here, it's a margin expansion strategy.
Okay, we've painted a pretty rosy picture. Turnaround, growth, tech moat, banking charter arbitrage. But my job is to be the buzzkill. We need to talk about the risks. Let's look at the bear case. Because that $20 million financing, it wasn't a gift.
No, it wasn't.
It involved convertible notes and equity units. That screams one word to me: dilution.
It is a risk. When those notes convert or those units vest, the existing shareholders are going to see their slice of the pie get smaller. That is a mathematical fact.
And for a stock that is trying to find its footing, a flood of new shares can act like a ceiling on the price. Every time it rallies, someone converts and sells.
That is true. But my rebuttal would be, what was the alternative? Without that financing, they couldn't have cleaned up the balance sheet. Dilution is the cost of survival and the cost of the turnaround. And with $46 million in cash now, they have the runway to execute so that the growth in value outpaces the dilution in share count. They bought time, and they bought stability.
Fair point. Dilution is a necessary evil sometimes. But let's talk about this commercial Bancorp deal. It's pending. We both know that regulatory approval for buying a bank is not a rubber stamp operation. The regulators can be incredibly difficult.
Absolutely. The acquisition hurdles are real. If the regulators say no, or if they drag this out for 2 years, the entire vertical integration thesis takes a massive hit. The stock is being priced, in part, on the expectation of this deal closing. If the deal falls apart, the cheap capital thesis evaporates.
And finally, I have to circle back to the earnings quality. We mentioned the non-cash gains earlier. If next quarter comes around and they don't have those accounting adjustments and the net income drops to near zero or goes negative again, the market is going to punish them. We need to see consistent operating income.
I agree. The quality of earnings matters. They need to show that the $5.1 million in revenue flows down to the bottom line efficiently without needing accounting help. However, the Wilson-Davis net capital is sitting at $14.7 million. That exceeds regulatory requirements significantly. It proves the underlying business is stable and solvent. They aren't skating on thin ice operationally.
So the foundation is strong, but the finishing touches, the bank deal, the consistent profits are still under construction.
That's the perfect way to frame it.
All right, we've looked at the fundamentals, the charts, the sentiment, and the risks. It's time for the verdict. Where do you land on AtlasClear?
I am assigning AtlasClear a bullish score of 8 out of 10.
8 out of 10. That is surprisingly high, given the regulatory risks and the dilution we just discussed. Justify it.
It comes down to the magnitude of the transformation. AtlasClear has successfully repaired its balance sheet. That was the biggest weight around its neck, and it's gone. They're delivering 84% revenue growth. That is not a small number, and it's not easy to do. They are positioning themselves as a scalable fintech platform that modernizes financial infrastructure. And frankly, the neutral sentiment score tells me that the market is sleeping on this. The stock is undervalued relative to the work they have already done.
So you think the market is looking in the rearview mirror at the SPAC debt, while the company is looking forward at the fintech platform?
Exactly. The market is pricing in the past. I'm pricing in the future.
What's the timeline? Is this a quick flip? Do we buy now and sell in a month when the bank deal closes?
No, this is a multi-year hold. You are waiting for the commercial Bancorp acquisition to close. You are waiting for the 2026 execution plan to play out. This is a play on the infrastructure of the next generation of finance. You hold this while they build the moat.
A multi-year hold on a balance sheet turnaround. It's a compelling thesis. The risk is there, especially with the regulators, but the cleanup job they've done is undeniable.
And in this market, finding a company with rising revenue and a cleaned-up balance sheet that hasn't been hyped to the moon is rare. That's why I like it.
That's the verdict on AtlasClear, a potential hidden gem in the plumbing of the stock market. Don't forget to subscribe, like, and comment on this video. Tell us, do you think the bank deal goes through? Are you worried about the dilution, or do you trust the growth strategy? Let us know below. Thanks for listening, and we'll catch you on the next one.